Recording in progress.
Okay, good to see everyone today. So we've got Sacred Account Saturday happening this Saturday today, right now, as always. I'm Jerry Fetta. It's good to see everyone. Steven Strinko is here from Dallas. Good to see you, Steven. Dallas is an awesome city. So guys, before we get started here, I want to cover kind of what our topic is going to be. And today is going to be about just the sacred account, obviously, right? That's what we cover every Saturday, but it's going to be more focused on the infinite banking concept, right? And the reason why is a lot of times we can get very lost in the product. We can get very lost in the details. What's my dividend rate and what is this and what is that? And let me look at the, all the nerd stuff. And we overlook actually the concept. We get too caught up in significance and theory and not enough in the practical. And so the concept is to become your own banker, right? The concept is not to know all the technicalities about how life insurance works, right? That's, there's people all over the world that understand how life insurance works. Not all of them are wealthy and using, the sacred account concept and the infinite banking concept to build their personal wealth, right? So we're going to cover that today. Now, before we do, I want to cover some ground rules, things we hit every single week. The first thing is I want to make sure that you have a purpose for being here. Right? If you're watching today, what made you tune in? Right? Are you here because you're new and you want to learn more about the sacred account and the infinite banking concept and start becoming your own bank? Is it because maybe you're already a client of ours and you want to learn more about how to use this successfully? Or are you just checking us out? You don't really know why you're here and this is the first time. That's totally fine. But I want you to think about, why are you here? Okay, what are you trying to get out of this? Because anytime we learn something and don't have an immediate reason to apply it and actually then do successfully apply it in the real world, we don't actually have knowledge, right? We might have consumed information and we might be able to regurgitate the information, but guess what? A parrot can do the same thing. So I want you to be more than just a financial parrot today. I actually want you to take what we're learning and do something with it. That's the difference between success and non-success, is the action that we take and what we're actually doing. Right? So that's the first point. The second point is, really quickly, I want you to remove any preconceived notion that you have that money is difficult, confusing, or hard to understand. That's nonsense, okay? And that's been pushed on us by banks and Wall Street because they want us to believe we need them. If they create necessity through ignorance, we're more likely to, flow them money and use their services and hire them for their advertised and apparent expertise, right? Whether they have that expertise or not, that's a different story, okay? So I want you to remove the idea that money is hard and this is going to be complicated to learn about, because it's really not. And I want you to, on the opposite side, it's like a pendulum that swings both ways. I want you to remove the idea that I know it all, or I've heard this already, or I've seen this before. Like, that's the enemy of greatness, guys. Like, this is success right here, just beginning, opening up here. Like, you could probably leave after this one and get your values worth out of today's lesson. Success is about doing the repetitive, boring work. It is not about new and exciting stuff. It is not about the latest and greatest. It's about doing the same thing over and over and over and over and over until you achieve your outcome. And most people can't stay focused for that long. Why? Because, I heard this already. I did this already. Guys, take any important area of your life. Take going to the gym, for example. It's the same stuff every day. You go lift weights and run. That's about it. Right? Like, you could vary that. Maybe instead of running, you dance or swim, but it's lift weights and go do cardio. And your ability to master the minutia of that and be consistent with the boring work really is going to be the outcome of success at the end. Right? Think about a marriage, for example, or a relationship. That thing works because you do the boring work every day. It's not new things all the time. It's a lot of the same stuff that you already know works. Right? And so instead of focusing on, I've heard this before, I've seen this before, let's embrace repetition. Let's embrace the fact that when you repeat successful actions over and over and over, they create an outcome. And just like we talk about with compounding interest with the sacred account, those actions are compounding as well. And if you have uninterrupted compounding successful actions, you get success. That's how it works. End of story, period. Okay, that goes for knowledge, that goes for application, right? So I want you to really embrace the repetition today. Okay. And so that's going to be something that's going to help you out quite a bit. Now, we have a few guests that invited some people. That's awesome. If you invited someone, let me know. I want to give you a free arena ticket and also your friend a free arena ticket. We have the arena bootcamp, digital bootcamp coming up on June 3rd. Okay. So if you invited a guest today and they show up, you're going to get a free ticket to the arena bootcamp on June 3rd. Your guest is as well. This is going to be a 6-hour event, 1 p.m. to 7 p.m. on Saturday, June 3rd. And we've got some incredible speakers of my friends and colleagues, partners, et cetera, lined up, right? We've got Artie Marin. Artie Marin, if you guys don't know Artie has been a huge proponent in wealth dynamics. He's one of my advisors. He's a partner in the company. He's got almost 50 years, I believe it's maybe even 50 years of international business consulting success and track record. He's worked with every type of company out there. Ivan Ans will be speaking. Ivan is the youngest family office founder in the world. We have Sean Wolf. Sean Wolf is a 5-time world champion bodybuilder. We have Chris Brown. He is the CEO of Tax Hive. Chris Brown has built $100 million sales teams. He's partnered with Kevin O'Leary. We have, Manuel Suarez, one of the top marketers in the United States. So if you've got a guest that's here today, you guys get a ticket to that. You get one, they get one, for inviting a guest and also for your guest for coming as well. Right now, before we get started, 2 things I want to go over. So the first one we're going to do that is a little bit new. Okay, this is an exciting new development that we are going to start working with you guys on today. And I want to show it to you. This is something that we've not unlaunched or released yet to the general public. Since you guys are here today on the course, you guys get first access to this. So if you're watching and you're not yet a client, first things first is I do want to give you a copy of my book, right? We cover this every week. This is always a free gift. Like one of the things that I needed free stuff when I started, right? When I first got into this, I wasn't confident enough in myself to even pay for an Audible book. Like on audible.com, I was using the free trial, right? I was literally I was trying to avoid spending $15 a month on a book, right? That's how poor my mindset was, right? I needed free courses. Like I was always trying to find a way to split the course with someone and not pay the full price. I was always looking for the shortcut, right? And I don't encourage that, but I understand that that's sometimes where people are at. We're skeptical. We don't have a track record yet. We haven't built up the confidence yet. So if that's you and you're watching for the first time today, and anything that I say helps you, okay, you get help this afternoon. You get some concept that takes your financial mentality to the next level. I want to give you literally a free copy of my book. This is called Blueprint to Financial Freedom. If you go to jerryfetta.com/B2F promo, you can grab a free copy of this. Right. And this book is going to give you step-by-step how to build wealth, how to build financial independence. Okay. So you go to jerryfetta.com/B2F promo, guys. And the importance of this is like having the data, having the information there, proximity to correct information. If you don't have the book, you can't get the information, you can't learn. Right. So I'm doing my own, it's called a Big 3 challenge right now, where every day for the next 90 days, I'm on day 9 right now. I'm studying finances for 10 minutes a day. I'm increasing my income. I'm taking actions to increase my income. And then I'm rating and reconciling my expenses for the day. Right. And what that's been doing is it's creating a transformation in my own finances. And guys, I've been doing this since I was 18. So if this works for me, it sure as heck will work for you. Right. So it starts though with education. So if you don't have the book at any point today where you're like, this has been valuable, I want you to grab the book. Okay. Now, the next thing I'm going to give you, and this is for anyone that is a current client or a new client, if you're not even a client even, right? So we are about to launch this to the general public. Since you guys are on Sacred Account Saturday today, I'm going to give you a sneak peek. We are in the process of developing what's called the wealth potential analysis, okay? And so this is something where if you're watching today, whether you're not yet a client, you are a client, you just started with us, I want you to reach out to Brianna. So Brianna Shaw is my endorsed wealth mentor on the call today. I want you to reach out to Brianna, and she's going to schedule you for a free wealth potential analysis. And what this is this is a 100-question assessment that's going to measure your personal finances against 100 different wealth building factors. And at the end of this, it's going to produce a graph that's going to show you, just like you see here, exactly where you're at with your finances. Okay, and from here, we're able to give you, here's what you need to do. Like based on what your graph says, here's what you need to do. If you're brand new with us, we're going to be able to show you right off the bat, here's where we can help you. Okay, if you're an existing client, we want to show you your progress. Not only can you do this now, but after you finish your Big 3 challenge or your next service or training with us, we'll do another one and we'll check and see, did your graph go up? Okay, this is how we create accountability. This is how we show, not only does what we do work, but it's how we measure, are you putting the work in on your side too, right? So if you're watching today, this is a free offer. You can set up a free one-on-one consultation with Brianna, schedule with her on the calendar, let her know, hey, I want to do a wealth potential analysis, and she'll help you set that up. And then we'll actually go over the graph with you and then give you your action plan. Here's what you need to do based on what the graph says, right? So that is another free offer today. Now, what I want to dive into with today's lesson, this is very important, guys, is the concept of infinite banking, right? The concept of infinite banking. Now, I'm going to start this out with a visual here. We talk a lot about the sacred account. Okay, the sacred account is the tool. So if you're not familiar with what the sacred account is, the sacred account is a form of life insurance. We use it to become our own bank, right? And it's a tool to help us do that. Now, the concept is what we're applying with the sacred account, and that's called the infinite banking concept. And the infinite banking concept actually is senior to the tool that we're going to use for it. You can practice infinite banking with life insurance, with gold and silver, with real estate, right? And I'll show you today what the concept is, right? And the reality is just so happens that life insurance is the best tool to accomplish this. But if there was a better tool out there, you can bet by all means we would be using it. But this is the best one that's out there, and it's the one that's got the most proven and strongest track record, right? And I want to go over this today because it's very easy to get lost in the details here. Trying to focus on what company is it with? What's the structure? What's the liquidity I have up front? What's my dividend rate? What are the internal fees? None of that stuff matters if you don't know how to become your own bank. Of course, by nature of becoming your own bank, we do need to set it up correctly and use a policy that's got the right structure, but you could become your own bank and not know any of that stuff and still be successful with it, because it doesn't negate the fact that it's there and it's happening. If you know the concept of becoming your own bank and how to be your own banker, you could do that completely ignorant to the fact of what the dividend is and why you're with the company you're with and why the design is what it is, because you're using a successful concept. Think about your car. You drive your car. Do you really know how your entire car works? No, the fact that you know how to drive is why a vehicle is valuable to you, right? You could study combustion engines and pistons and alternators and all these different vehicle parts and still not know how to drive. Okay, I don't care about teaching you how a car works. I want you to drive. And so today we're going to focus on how do you drive, not how does the car work, right? And if you don't have a car, it doesn't matter how the car works. You can't drive anyways. You don't have a vehicle to drive. So rather than driving, we're becoming our own banker. Right now, I'm going to dive ahead into some different areas today. And I want to hit this one first, right? We've covered this before, but guys, this kind of goes back to what I call a fixed idea. A lot of our financial life is based on uninspected ideas that we collect from other people. And we don't look at their track record. We don't look at their validity. We don't look at where it came from. We don't even look at it if it's successful, right? Who's gotten the advice, put money in your 401k plan? Okay, put money in your 401k at work because you get a free match, right? And you get a tax write-off, and then you can build your account up for retirement. So let's take that for example, right? One of the questions here is, what do you know about your retirement account? Okay, so let's say you're putting money in your 401k. Okay, did you know, just as an example, did you know that your 401k plan is what's known as deferred compensation? Okay, what does the word deferred mean? Deferred means later. Okay, what is compensation? It's being paid. So a 401k plan is a form of being paid later, right? So that means that you're opting to not get paid today. I don't want money today. Do not pay me the money today. Instead, put it in this plan where I get paid later, right? So the other half of this is the free match. It's not actually free. Is it right or wrong that it costs you $1 before you get the match? You've got to put your own money in first before you get the match, right? If you don't put money in first, you don't get the match. So is the match really free, or does it require exchange where you've got to put money into the account first to get the match, right? So it's not a free match. Let's check out this one, the tax benefit. So you're getting a tax deduction today, right? You're going to write it off on your taxes today. That's the reason someone might do a 401k account, with the idea that they're going to pull the money out later when they're 60 or 65 or 70, and they're going to pay the taxes later, right? And the idea is, okay, well, hopefully taxes are lower and you don't need to withdraw as much money. That's a load of crap. Think about, like, I'm 30. So if I'm contributing to my 401k when I'm 30, and then I pull money out in 30 years from now, first question, is it going to cost the same, less, or more money to buy the same things I can buy today? If you look at inflation over the last 30 years, it's going to cost a lot more, right? I'm going to have to withdraw even more money to maintain the same standard of living that I have today. The second question is, do you really want to work for the next 30 years to have a lesser lifestyle than you have now? Is that really the goal? Like, are you really doing all this hard work so that in 30 years, you can reduce your lifestyle? Why would you want to do that? Like, for me, I want to improve my lifestyle. I work so that I can have a reward, not a penalty. Like, you work for 30 years, great, now we're going to reduce your lifestyle. That's a penalty, not a reward. I don't like that, right? But that's what the retirement community teaches. Now, here's another one on the tax benefit. You get $1, you know, to write off on your taxes today. If you put $1 in, you can write it off and save 25 cents, right? But if it takes me more money to withdraw in the future, the other question then becomes, are taxes going to be higher or lower in the future? Okay, let me give you that answer in the long term. Taxes are like the stock market. They can go up and down from year to year. But the first tax bracket ever for the top income earners in the country was 7%. 7% all the way back in 1913. Okay, today it's like 40%. That's just federal, not even state. That's not even like Social Security and Medicare and, you know, net investment income taxes. So you're looking at, you know, for a high income earner, potentially 40, 50% in taxes. Taxes have increased 1 to 2% per year for the last 100 years. So if we keep that trend, taxes will go up in the future. Our country's borrowing more money. When we borrow more money, we pay more interest. Those interest dollars have to get funded with what? Taxes. So the myth is, I'm going to put $1 in, I'm going to get a tax deduction today, and then I'm going to pull it out and there's some benefit later. Well, no, I'm going to have to pull out more money to buy the same things that I buy today at a higher tax rate in the future. More money pulled out times a higher tax rate equals the money that I will pay in taxes is going to be more expensive than the deductions that I get today. Right? People don't tell you this. Do you really think the IRS is going to give you a way out of paying taxes? Right? And then what's happening? We didn't even talk about what's happening in between. What's happening in the next 30 years if my money's in the 401k plan? Well, Wall Street's taking fees out of it. They're using it to make themselves wealthy. Right? Those are fixed ideas, guys. Okay, another one, compounding interest. Okay, we hear the phrase that Albert Einstein states that compounding interest is the 8th wonder of the world. If you research that, he never said it. Albert Einstein never said that. That was created in the 1900s by an investment company. It was false advertising, and they were using it to sell more mutual funds. That's another Wall Street giving you wrong information to make you think you need to give them money. The reality is, for an investment to compound, you have principal plus interest plus principal plus interest multiplying every single year. It's like steps, right? So every single year, it's got to level up. And if it doesn't level up, it's not compounding interest. Meaning if you have a year where it doesn't grow, your compounding got interrupted. If you have a year where it goes down, your compounding got interrupted. If you had a year where you withdraw money, that compounding got interrupted and you don't have compounding interest. The only way to have compounding interest is to never lose money and always make money. And there's only one account that I know of in the world that does that. And we're going to talk about it today. But again, it's not about the account, it's about the process. Right? And what is that process? I want to jump into this with you this afternoon. Let's talk about the infinite banking process. Okay. So we've gone over this slide on previous lessons, but this one's so powerful, guys. This is the concept at work. This is the opening, kind of laying the framework, the groundwork for it. Okay. So you have $25,000 in the bank, right? You've got $25,000 in the bank. And this bank, let's say it's a magic bank and they're paying you 4% interest on your money. Okay. You've got $25,000 and 4% interest for 60 months, right? Now you want to buy a car. And just like anyone, you have two options. You can pay cash, take your money out of the bank. If you take it out of the bank, you won't earn 4% anymore, but you will pay cash for a car, right? That's option number one. Option number two is you can leave your money in the bank where it's still earning 4%. So you leave it all there. And instead, you go to the bank and you get a loan for $25,000 to buy the car. And the bank tells you, good, we're going to charge you 6% on this loan. You're going to pay us $483.32 a month for the next 60 months, right? Now, the average person with conventional thinking, what they're going to do is they're going to look at, okay, if I have the money in the bank, I'm making 4, right? If I spend it, I lose 4. But if I leave the money in the bank, I'm making 4, but then I've got to go get a loan because I can't use my 25,000. It's in the bank right now. So I'm making 4, but I'm paying 6. I would rather not pay the 6%. 6% is worse than 4. So I should spend the 25,000, not make the 4%, and avoid paying 6% interest because 4 is less than 6. That's how the average person would do this math, right? And that's how I would have done this math many years ago. Now, the problem is, it's not about percentages, it's about dollars, right? One of the first rules to becoming your own banker is you deal in dollars, they deal in percentages. You being, if you're your own bank, the banks, they don't deal in percentages, they deal in dollars. They make you deal in percentages, but they don't do their profit and loss statement in percentages, they do it in dollars. They don't pay their shareholders in percentages, they pay them in dollars, right? So if we look at the math on this, if I would have done the car, financed at 6% for 60 months, $483.32 a month for 60 months, I would have paid $28,999. $28,999. Okay. That's what I would have paid. Now, if I would have paid that and left my money in the bank at 4%, my money would have still grown to 30,000, which means I would have made profit. I would have actually made money on this transaction if I would have taken a loan from the bank. I would have made $1,526. Right? Now, if I pulled my 25,000 out, sure, I avoided paying interest, but I avoided paying 28,999, but I also don't have 30,000. I don't even have 25,000. The reality is if I pay cash for a car in 5 years, that 25,000 is worth 12. So what did I do here? If I pull my money out of the bank and pay with cash, I turned 25,000 into $12,000. If instead I left my money in the bank growing, I turned 25,000 into 30, and I only paid $28,999 and I made $1,500. So again, the banking concept, would you rather lose 12,000 or make 1,526? Right? Kind of an easy answer, but you'd be surprised how many people, because of the percentages, can't see past this number because they're not thinking like a bank, they're thinking like a consumer. Okay, a consumer consumes things, right? They're not thinking like the people that are producing it. So what we're going to do is we're going to introduce whole life insurance into the concept. I'm not even going to talk about what it is today and how that works. I want to talk about just the concept, right? And the concept has to do with this thing called the banking quadrant. Okay, so the banking quadrant works like this. This is how all banking works. So there are depositors. This is step 1. Depositors put their earned income into the bank, right? You see the piggy bank here, right? Now, when a depositor does that, the reality is they're not making 4%. The average savings account rate at the high end is paying about 0.40%, right? Now realize this is not theory. You're already doing this. You're already depositing this money into the bank, okay? The bank then borrows against those deposits. See, most people don't know this. The bank is borrowing 98 to 100% of your money. Meaning when you deposit the money, you have 0 to 2% of your money actually there. 98 to 100% of it's gone. The bank took it. It's no longer in the bank. That's the reason they're paying you interest. You just loaned them your money. They're paying you 0.4% interest per year to borrow your money, right? Now, why are they borrowing your money? They're borrowing your money because they're going to go use that to make money. They're going to loan this out to someone. They're going to loan it out on a car payment. They're going to loan it out on a mortgage. They're going to loan it out on a construction loan, a debt consolidation loan, a private loan, a line of credit, whatever they're loaning it out on. Let's say it's a mortgage and it's conservative and they're loaning it out at 4%. Right at 4%. So they're making 4% on your money, not their money, on your money. They put your money at risk. They make 4%. They pay you 0.40 and they pocket the difference. Right? So that means that they're pocketing 3.60% spread. That's the money they're making on your money. Right? Now, if we just do the math on this, right, we can look at they've put in none of their own money. So they put in 0 and they're making 3.6%. What's 0 divided by 3.6%? It's infinity. They're making an infinite rate of return. This is why we call it the infinite banking concept. The banks use this and they make an infinite rate of return by borrowing against your deposits. Again, guys, this actually happens. Your money in the bank right now, this happens to it as we speak. Now they take this money, they invest it, they make profit, then they pay that to their shareholders. There's people that own the bank and those shareholders earn dividends based on bank profits. And so they make the profits, they pocket the difference. You make little to nothing while your money is being put at risk. Okay, I like to explain this with a car. We've been talking about cars today. So let's say that you're going on a trip. You and your family are going on a trip. You're going to the airport. You're going to drop your car off, right? And you drop it off at one of those little parking garages by the airport where you pay them and they'll leave your car there so no one breaks into it, right? And while you're gone, you're paying for storage, right? And you think your car is being kept safe, but you come back and you find out that while you were gone, they rented your car out on Turo. Turo means they're renting it out to other people. They're renting your car out to other people. They're making money on it and you're not making anything and they put your car at risk. And you end up going to the place when you're done with your trip and you go to the garage and you say, hey, I got my keys here. I got my sticker. I'm ready to pick my car up. And they say, sorry, ma'am. Sorry, sir. We don't have your car, right? It's being rented out right now. And you're like, wait, what do you mean you don't have my car? And then on top of that, they tell you, not only do we have your car, but we don't have your car, but someone, we rented it to them and they wrecked it. And you're like, wait, so you rented my car without telling me and then someone wrecked it? You better have insurance. And they say, oh, well, we do, but we haven't been paying it. So your insurance is going to need to cover it. And because of that, yes, your premiums will go up because you're the one that has to pay. Right now, what does this have to do with the banking quadrant? Instead of a car, it's money. You're parking money somewhere while you go live life expecting it's being kept safe and that it's there and it's growing for you. In the reality, it's not. It's being loaned out to other people. Right? And the bank loans this out to other people. Sometimes that makes them money, right? Sometimes it doesn't. Sometimes they lose money. Look at Silicon Valley Bank, look at Signature Bank, look at Credit Suisse, look at First Republic. There's a bunch of other banks that are about to go under because they lost your money. Just like if they rented the car out and the car got wrecked. Now, where does the insurance come in? Well, we're like, Jerry, everyone knows that there's FDIC insurance, right? Well, in Silicon Valley Bank, over 90% of their deposits weren't actually covered by FDIC insurance, meaning that those people lost their money and didn't get paid. Not only that, but sure, there's FDIC insurance, but the bank is responsible to pay the premiums. Just like any insurance, they have to fund it. They have to pay the premiums. If you don't pay your premiums, the insurance company has no money to pay out claims. Okay, several years back, the banks lobbied Congress to no longer pay the premiums on FDIC insurance. Therefore, the FDIC not only isn't collecting any sort of premiums from the banks, but there's only enough money in the FDIC to cover about 2% of all deposits in existence. Meaning if everyone lost their money in the banks and the FDIC had to bail them out, there's not enough money to do that. Only 2% of the money is there. Now, what happens when this happens? They're not bringing in premiums. They don't have enough money to cover everyone. The FDIC then has to borrow money from the US Treasury, which is what happens right now. Okay, the US Treasury is you and I, because the US Treasury collects their money from tax revenue. So we have to tax citizens for the Treasury to get money, for the FDIC to get a loan, and for the FDIC to then bail out the banks, which means that you're the one footing the bill. Guys, it was your money that went in the bank. It was your money that got borrowed against without you knowing about it. It was your money that was invested to make the bank's profit. It was your money that was lost, and it's your money that's going to pay everyone back when the bank can't pay. That's the banking quadrant. Okay, I thoroughly believe this system is evil. I believe that it's set up to prey on Americans. It's set up to prey on Canadians. Anyone that puts money in a bank account, they're being taken advantage of by the bank. I think it's an unethical system. Okay, I don't believe in it one bit. I keep as little cash as possible in the bank, right? Now realize this is already happening. This is not a concept that's like a theory. It's like if you have money in a bank, this is going on with your money as we speak. And if you don't believe me, you can go Google the term fractional reserve banking and you can go find what you come up with online. It's there. It's been happening for hundreds of years. It's how banks make money, right? So that's the banking concept. Now we changed just one thing. Okay, we're going to change just one thing, and back to the car example, right? We're not changing anything but one thing, and that one thing is the location of which you store, where you store your money. Okay, here's an example. Let's say that I tell you, hey, and I'm talking to Bree here as an example. I tell Bree, I say, hey, I've got $1 million for you, and Bree's like, that's awesome. And I tell you, yeah, but it's in company stock that right now we can't get to, right? Does Bree really have $1 million on paper? Yeah, but does she have access to it? No. Versus Bree actually having $1 million. It's not about what you keep, it's about where you keep it. Okay, another example that's a little more practical. You've got $300,000 in a retirement account that you can't touch for the next 30 years. And if you do touch it, you're going to lose half of it. So if you have it now, you only have 150. If you wait till later, who knows what you'll have? Maybe it'll be more, maybe it'll be less, but on the statement it says 300,000. Do you really have 300,000 right now? No, you have a piece of paper that says that somewhere in your control that money exists, but you don't have that money today because of the location, right? So it's not about what you keep, it's about where you keep it. So let's change where you keep your money. We're going to take it from the bank, and instead, we're going to move it over to the sacred account. And the reason why is we want to teach you to become your own bank. We're not putting money in their system anymore. We're putting money in your system, right? And so here's how this would look. If you're putting it in your own bank, okay, same numbers, same math, same everything, right? You've got $25,000 in your own bank. This is you now at 4% for 60 months. Same math, 4% for 60 months. Now, the reality is with the infinite banking concept, it actually is 4%. It's not 0.40, it actually is 4%. And so in the future, that money would be worth $30,525, just like we talked about in the last example. But the difference here is, again, you didn't put it in someone else's bank, you put it in your own bank, right? Which means you are going to loan that money to yourself. Okay, again, same thing. Now, this is the part where you might look at me like I'm crazy. You're like, why would I loan money to myself? Why would I borrow against my own money? Okay, there's a couple of reasons that we're going to handle here. Okay, so real quick, before we talk about why we would borrow the money, I want you to just hear me out on the math. I'm a math guy. The math and the concept needs to make sense. Then we'll talk about why you would borrow your own money. Okay, but you're going to loan your money to you. Same 25,000. You're the banker and you're also the borrower. You need to play both roles here, right? Like it's kind of like you're maybe a dad and a business owner. You got to play both roles. You can't be like, I'm a business owner with my kid and we do business deals, but I'm not really a dad. No, it doesn't work. You've got to be both. You've got to be both, right? So you have the money here. You're loaning it to a borrower, right? That borrower is you. You've loaned yourself $25,000. Now, let me ask you this. If you're the banker, let's say you loaned this money to someone else. Let's say it's not a borrower. Let's say it's your buddy from work. You loan him $25,000. Would you charge him interest? I would. Would you expect your buddy to pay you back? I would. Would you expect to be paid back as agreed? I would, right? Now, on the flip side, let's say you were borrowing money from someone else's bank. Would you expect that they would charge you interest? Yeah, they would. Would you expect that they would want you to pay them back? Yes, they would. Would you expect that they want you to pay as agreed? Yeah, they would definitely want to. So we're going to do the same thing. You're going to charge yourself 6% interest for 60 months. You're going to make a car payment of $483.32 a month back to your own bank, right? You're paying yourself over the next 60 months, $28,999. That's $483.32 for 60 months. $28,999 paid back into your bank now. That's your car payment. But your money is still growing at $30,525 like it never left because you're being your own bank. You're using the life insurance concept. Right? Now, there's a story, Nelson Nash, he's the founder of the infinite banking concept. Nelson is a personal hero of mine. And so if you study Nelson Nash, you'll see a lot of this with what he learned and how he applied this concept. But he has a story of early on, he was working with a client and that client used the infinite banking concept to pay off their house. $400,000 house, right? 40-year mortgage back in the day when they could do a 40-year mortgage. And the client was ecstatic, apparently. They were like, I paid off my house. I don't have a house payment anymore. And he stopped them right there. He said, no, 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 no. You still have a house payment. And they're like, no, I don't. I paid off the house, right? It'd be like, hey, you had a car loan, you borrowed and paid it off. He's like, no, if you borrowed from your bank to pay off your house, you still have a house payment. That house payment, in this case, it's a car payment, is the payment you're going to make back to yourself. You're going to keep your commitment. Whatever you were going to pay their bank, you're now going to pay your bank instead. Okay, now hear me out on this. Why? Because what else are you going to do with the money? The other option, guys, literally is to go stick it back in their bank. Why would you set up your own bank to finance your own vehicle, to then take your money that you would have put on a car payment and instead stick it in a checking account with Bank of America so they could do the exact thing we just told you to get out of? And it's flying in the teeth of the concept you just set up. That makes zero sense. You would pay the money back to your own bank. That's the point of having your own bank. Right? Let's demo this out with a grocery store. Let's say that you own a grocery store. Okay, this is another concept from Nelson. You own a grocery store and you're buying peaches and you're like, okay, well, I own the store. So technically I get free peaches. I don't need to pay for them. No, that's not true. You do. Right? Why? Because the store is its own entity. You can't wear the hat of being a customer while you're the owner of the store. There's no such thing as free peaches. Those peaches did cost your store something, and that will come out of your bottom line. And so you would instead pay for your own peaches. Right now, even worse would be the idea of taking this payment and putting it in someone else's bank. That would be more like you own your own store. You're like, I want peaches. I'm going to walk across the street to my competitor and buy it from them. That makes zero sense. You're now in the banking business. If you have a Sacred account, you're now in the banking business. Every other bank out there is now your competition. You don't give your business to your competition, right? That's like a chief rule in business. You keep the business for yourself, right? So that's the concept here of being your own bank. And if you guys have questions on this, drop them in the chat. And I want to just check this out again. If there's any questions, let me see if there's any. I don't want to go too forward now. If you guys have questions, I want to stop and answer them real quick. I don't think we have any big showstoppers on questions yet. So I'm going to move on to the next slide here. Okay. So to answer your question, why would we borrow against our own money? Okay. So there's a couple reasons why. Let's say you have an asset and it's producing, it's growing. True or false, if you withdraw that money, that growth no longer happens. Right? So if I had a stock that was producing a dividend or a gain and I sell that stock, am I still making money on that stock? No. So withdrawing causes you to lose growth. Right? Now, here's another thing. Same thing. If I have a stock and the stock grew and I sell it and I made a gain, we withdraw the money, we pay taxes on our gains. Rule number one of investing is never lose money. Okay, if I'm an investor, there's two things that I hate. It's losing an asset and paying taxes. And when I withdraw money, both of those things happen. I lose the asset and now I pay taxes. I don't want that. I don't want to lose the asset. I don't want to pay taxes. So by borrowing, the asset's still there growing because I borrowed against it. I didn't withdraw it. Okay. And by borrowing, I didn't actually have a gain. So by borrowing the money, there's no taxes. Loans aren't taxable. Okay. The other problem with the withdrawal is we've traded an asset that gains value for an asset that loses value, AKA cash. Okay, whoever can answer this correctly, okay, who can tell me the answer on this? On I think it was 2021, actually, like last year, the year before, the inflation rate, right? What was the inflation rate? What did money go down in value by? Through 2021, 2022, over that time period. Who can tell me the correct range? You don't need to be on the dot accurate. If you can answer this correctly in the chat, you get a free arena ticket. Okay, Steven has an answer. Let's see what we got for answers here. Okay, Steven says 9%, right? Jason says 7%. Ian says 7 to 8. Those are all correct. Okay, 7 to 8%. Anna says 8%. So Bree, can you make sure that Andrew Davis, Jason, Ian, and Anna all get an arena ticket? Very well done, guys. Financial literacy does pay off, see? And if you have a ticket already and you just want a free one, Steve says 10%. Yep, Steve is also right. So let's make sure Steve gets a ticket. If you already have a ticket, use this as a +1. Bring a guest. Okay, this again, June 3rd. Okay, so by borrowing, our funds keep growing and at a rate higher than what we borrow for. We borrow on a sacred account. Usually we're earning about 3 to 5. We're paying about 1 to 3. So we're making a positive profit spread there. That's the idea behind it. So we borrow at a rate higher than what we borrow for. We pay no taxes and we keep ownership of assets that gain value. Okay, we want the uninterrupted compounding. Awesome, you're welcome, guys. Okay, good. So that's why we borrow against our own money. Now, guys, here's the reality. Here's some math on this. This is actually what is happening when you put money in a bank, right? So let's say that I give Anna $100,000. Okay, I'm doing a business deal with her, and I give Anna $100,000, right? And she's providing a product or a service. Anna would take that 100,000, and generally we would put that in our bank. That's what we've been taught to do. So let's say that Anna hasn't yet seen this presentation. She doesn't yet know about the sacred account. So she puts the money in her Wells Fargo checking account. Okay. Now let's again say it's one of these magical banks and they're paying Anna 4%. When in reality, they're paying her 0.4%, but let's say it is 4% just for math and magic's sake, just to give the banks the benefit of the doubt, right? They used to do this a long time ago. You used to get 4s. Not so much anymore. They like to stick that decimal in front of it. But the bank is paying Anna 4%. Now that 100,000, the bank loans this out on a home mortgage. Okay, they're going to charge the mortgage guy borrowing this money 7%. Now they owe Anna 4, they're charging 7, so they make 3% profit there. Now what happens when this guy does the mortgage? He's going to take the proceeds from the bank and pay the seller. So the seller now has the 100 grand and he now puts his 100 grand in the bank as well. He's also now making 4%. Okay, so he's making 4% on his money. The bank takes that cash, they loan it out to someone on a car loan, and they're charging 8% on the car loan. Right now, they owe 4% to the seller of the home that deposited the money. So the bank is making a 4% spread there. Okay. Now, when this guy pays for his car loan, that money goes to the car dealer. What does the car dealer do? The car dealer puts it in their bank where they're making 4%. And the bank takes that money and they loan it out on a home remodel loan, charging 9%. 9 minus 4 is 5. The bank is making a 5% profit spread. Okay, so we then have the guy with the home remodel. He pays for his home remodel. This goes to the construction team, who then deposits it into the bank again. They're making 4%. The bank takes that money, loans it out on a debt consolidation loan, charges 12%. Again, they're paying the construction guy 4. They're keeping a profit of 8%. When that debt consolidation loan happens, the money from debt consolidation pays off the credit cards for this guy. The credit card companies then put the money where? In the bank. Okay, so here we see the bank made 3%, 4%, 5%, 8%, total of 20%. What are they paying you? 4. Okay, they're paying you 4, they're making 20. They're making a 500% profit margin on your money. Putting none of their own money at risk, by the way. This is not their 100,000 at any point in the game, right? So if you know this is happening, why would you keep doing it? Right? It's like if you knew you were eating something that was going to give you cancer, you would probably stop. Right? If you had, your finger in the outlet and it was shocking you, you would probably pull your finger out. Why? Because it causes you pain. But most people, this is disguised so well. Most people don't identify that this is the source of their pain. If you became your own banker, paycheck to paycheck doesn't really exist anymore. Having credit card debt doesn't exist anymore. Having a car loan, having a mortgage doesn't exist anymore because you are your own bank now, right? Your financial pain goes away because this is the thing causing it. Good. So I'm going to jump in on my next slide here. And guys, here's the stat. Banks make between 400 and 1,300% on the money you leave there. This is from Bauer Financial. Again, real math, real stats here. So they're making between 400 and 1,300% on your deposits, and they're paying you what? 0.40. So the banking quadrant, again, guys, this is the concept. We're going to change just one thing. And that one thing is you're going to become the bank, right? And by becoming the bank, that one thing changes everything, right? And we're changing this one thing to become the bank, which is the location where you put your money. You're not going to put it in someone else's bank anymore. Instead, you're going to put it in the sacred account. right? Now, this is life insurance. And if you look at the concept here, we'll validate the concept, but if there was a better one out there, we'd use it. It is life insurance, right? For those of you that are in sales, like if I could tell you it wasn't life insurance and it was a product that had, less skepticism towards it, because you say life insurance and people are like, oh, that's a scam. Dave Ramsey said this and my friend said that. Like, if it didn't have to be life insurance, trust me, I would love that. It would be so much easier to introduce the concept to people, but it is life insurance. And that's just the nature of the beast. Is this is the by happenstance, the tool that gets the job done. So we're not married to the tool, we're married to the concept, and we're going to use whatever tool does the best job. And it just so happens that this is the one that does the best job. So you're going to deposit your money into your life insurance. Okay, you're going to earn a guaranteed rate, and you're going to get better protection. And you're going to get a death benefit and tax-free growth. And you're protected from creditors and lawsuits, and I can go on and on and on, right? But you deposit the money in the life insurance. Now, the life insurance company makes you a shareholder, right? You immediately become an owner in the insurance company. This is why this system works. You become an owner in the insurance company. So you earn guaranteed interest. You also earn dividends on the profits of the insurance company. Now, the insurance company will let you borrow against your deposit. You can now be the bank. So if your money on average is making between dividends and interest 3 to 5%, and you borrow, and your cost of borrowing is 1 to 3%, what you have here is you've got the ability to borrow money that's growing at 3 to 5 and only pay 1 to 3. Right now, a lot of people are like, oh, I don't want to pay interest on my own money. Guys, the bank doesn't care about the interest they're paying on your deposits because they're making more money than that. We're not telling you to do this and then go get into credit card debt with it. We're telling you borrow at 1 to 3% interest. Your deposit's already making 3 to 5. Loan this to yourself and use that initially to pay off debt, then to build up your reserves, then to do large purchases, and then to invest. And when you pay off debt, let's say you have a credit card and you're paying 19%, right? So you pay off the debt. You've now freed up, you're debt free. You've now freed up the monthly payment and you're earning 19% interest by not having to pay 19% interest to someone else's bank. So if it costs you 1 to 3% to save 19, did you or did you not make money? You did. The bank, back to this previous example, they're not complaining when they loan the money out on a debt consolidation loan at 12%. They're not complaining that they've got to pay you 4%. Why? Because they're making profit. They're doing a profitable activity. They're making more than it costs. Right? Now, where you got a one up on the bank is you're also the depositor. So you're also earning the interest on your deposit and you're the shareholder. So you're getting dividends. You've actually got a better system than the bank. You're earning guaranteed interest on the deposit. The bank doesn't earn the interest. That's money they've got to pay to you. Okay. They borrow, right? They pay the interest, but they don't get the benefit of paying the interest. You do. Okay. And so that deposit is going to keep growing. You then borrow, you use it for smart financial decisions and you make money or you save interest, you free up your income. Okay. And then you pay this back to your bank. You recapture the money. You pay off a car loan, you put that back into your own policy loan. You invest it and you make 12%. You take the cash flow from that investment, you pay back your policy loan. Right? When you pay the interest, this is interest paid to the insurance company that you own and you earn dividends. Okay? So you get to be the depositor, you get to be the banker, you get to be the borrower, and you get to be the shareholder. Guys, the bank only gets to be the right side of this quadrant. They're only the bank and the shareholder. They don't get to be the borrower. They don't get to borrow your deposit and loan it out to themselves for a car. The borrower is someone else. So you actually have more benefit than the bank by using the infinite banking concept. Right? And I want you to think about, what if you never paid $1 of interest to another bank in your life that wasn't yours? Right? The car payment wasn't a thing. The credit card wasn't the thing. If you have kids, imagine your kids growing up and never having to worry about debt. Imagine funding a policy for them where in their early 20s, they've got a couple $100,000 of their own money in their own banking system, which, by the way, is completely protected, tax-free. Like nothing can ever happen to that. That's the infinite banking concept, becoming your own bank. This, again, guys, I want to just bring it back to you. This is going to happen to your money. It is happening to your money. Do you want it to happen to your money at your expense for someone else's benefit? Or would you want this to happen to your money because you're the bank and you're the one that's doing it? It's not at your expense and it is for your benefit. Right. And so the first step of this is education. That's what we're covering today. The second step is the decision to boycott banks. Guys, look at what's happening right now. Like we had Silicon Valley Bank go under. They practiced this concept. They borrowed against the money in the deposits. They loaned it out and invested it in very risky investments. They lost the money, didn't have the deposits anymore. When people asked for their money, they couldn't get it back. The bank went under, and hours before they closed, the executives of the bank wired themselves bonuses. When are you going to be out of this abusive financial relationship and say enough is enough? Right? Look what they did in 2008, guys. That was the banking system that did that on purpose to make money. They got paid, bailout money from the government. What did they do? They didn't bail you guys out. They didn't help us. They, again, paid themselves bonuses. You need to say, I'm done with the banking system because now I can become my own bank, right? And this means that I take responsibility for my finances, right? So we've kind of gone through the mechanics. I'm going to show you guys this in action real quick. So I'm going to show you real quick how to get all the money back for every car you will ever buy, drive, and own. Okay, all of us needs a car. We've talked a lot about cars today. I think probably one of the commonalities that most of us have probably is a car payment. So let's give you an example. So the sacred account, let's take a look under the hood. We're going to look at premiums, which I want you to consider as your deposits. We've got the age, which really doesn't matter. You can do this at any point in time. We've got the death benefit, and then we've actually got the money in your cash value in the sacred account. So let's say that in year one, you put in $10,000 in deposits. Right now, let's say this is a really poorly designed one where you've only got like 58% liquidity. You put in 10,000, you can borrow out 58.73. Now you don't need the money in year one. You need it in year three because that's when you plan on buying a car. So you put in $30,000, right? And in year three, you purchase a car for 25 grand. Okay. Now what happens is you pull the 25,000, you put that in the car. You've still got the ability to borrow another 4,200. But the 25,000 is growing like it never left. So you pull the 25,000 out, you pay for the car. You now start making car payments of $6,000 a year back to yourself, right? Now, you continue doing this. You're putting in $10,000 a year still on the front end. You're building and capitalizing your bank. You're making your car payments back to yourself as agreed. Okay, by the end of year 7, between total premiums and loan repayments, you've paid in $100,000. And your cash value growth is 67,881. Okay. And you've got a car, right? Let's not forget that. Year 8, you buy another one. You're like, I'm going to do another car now in year 8. So you borrow 25,000 out anymore. Now you never actually put money into your account ever again. Let's say you stop at year 7 and never put another dime into it. I wouldn't recommend that, but just to show you this thing pays for itself. And so you pull out the 25,000. And you start making a car payment of $6,000. You paid off the first one and you're going to do a second one. You're paying yourself $6,000 a year still, right? At the end of this, from year 8 to 12, you paid in $30,000. Your cash value growth was $23,592. Okay, year 13, you paid the car off. You do another one, right? So you now have 2 paid off cars, right? You've got cash value growth of over $90,000. Okay, and you've got a third car you're now working on. So you borrow 25,000 out, you make the same payment back to yourself, $6,000 per year, right? And basically by the end of this, you've paid yourself 30,000 in loan repayments. Your cash value growth is 32,005. Okay, now we scroll down a little bit. You do this one final time, right? At age 43, you say, okay, I paid off the third car. Let me buy a fourth one. Right, and you pay yourself, again, the same thing that the car payment was before. You pay yourself $30,000 over this period. Your cash value growth is 43,000, right? Now, at the end of this, you've got what? 4 paid off vehicles, and you got $167,000 in cash value by financing 4 cars. You show me another bank where you can borrow 25,000 out, pay yourself a $500 a month payment. Like, realize this is the same money. Like, you're saving money in a bank and you're borrowing from a bank and you're making payments to a bank on a car. All of us have done this at some point or currently do this. At the end of 22 years, you're not going to have 4 paid off vehicles and $167,000 in cash. Right? Why does this work? Because you've recaptured the money. right? You've recaptured your wealth. You are the bank in this equation. Okay, and this works for 3 reasons. The first rule is pay yourself first. A bank doesn't have money until it has deposits. You're the depositor, right? This is the difference between you and your bank and them and their bank. They're going to collect the deposits from a bunch of strangers, right? You've got to fund it out of your income. So pay yourself first. Okay, that's rule number 1. Number 2, pay yourself with interest. If you borrow money, you pay yourself back with interest. And then rule number 3, you recycle and recapture your money, right? So let's just go back to this example. Okay, you put in the first 7 years, 70,000 in contributions. You borrowed out for the car, 25K, right? You put in 6,000 a year in loan repayments. You paid yourself 30K, right? 25,000 comes out. So you put in 100, you pulled out 25. Okay, you have $75,000 there. Now, as far as the money you've got available in your cash value over the 7 years, you've been able to borrow 91% of any dollar you put in. Okay, year 8 through 12, you never put another dime into it. You pull out another 25,000, right? So you had 100, right? You had 100, you pulled out 25, you had 75 left. You basically paid yourself 30, you pulled out another 25,000. And math would say, well, 25,000, 30 minus 25,000, you've got $5,000 left. Well, no, you've actually got cash value left of 23,592. And that's because the money kept growing the whole time. Your cash value is 91,473 total, right? By the end of this. Okay, and let's look at the math on this next page. Like this just shows you, and this is actually on debt, right? This kind of shows you the picture here. But on this, let me go back actually. I think I'm missing a slide here. Nope, I'm good. I'm not going to go into the debt one because we're going to run out of time, right? But you know, this example with the debt, I want to just show you this last slide. So this guy is a real situation of a real person that used the sacred account to pay off debt, right? And the reality of this situation is they were putting in $25,000 per year for 3 years. So they put in 75K. They borrowed out 55,000 and used that to pay off loans in years 1, 2, and 3. Right. And so again, if you're using someone else's bank and you put in 75,000, you pull out 55,000, what do you have left? You've got 20,000 left. But if you're using your own bank, you put in 75,000, you borrow out 55,000, you still have 75,000 there growing because you used your bank instead of theirs. Right. So can you see, like, we haven't talked about anything product related today. We have not talked about the dividend rate. We've talked about the concept. The concept is you set up your policy, you stop using other people's banks, you use your bank instead, you deposit money into it, you borrow against the policy, and you use that for anything you would ever use a bank for in your life. You finance everything. You're either paying interest, inflation, or taxes. Every single thing you do with your finances, including leaving money in the bank, is going to cost you, right? You're either going to pay interest because you borrowed money, or you're going to pay inflation because you didn't invest the money, or you're going to pay taxes because the money's not in a tax shelter. So you have to realize that's financing costs. Every single thing you do in your life with money will have a cost. And so you have to look at, there is no cost-free option here. Leaving money in the bank is not a cost-free option. You're going to pay taxes on the money in the bank, and you're going to pay the cost of opportunity with inflation. And you're probably going to go take loans from the bank and pay them interest. You're probably paying all 3 on that, right? Now, this gets a little bit crazier. We're going to jump into the next one. I'm going to skip through the debt part. Let's talk about investing real quick. Okay, so Ted puts $100,000 into his sacred account. Okay, he wants to invest that as a lump sum in real estate. So if I've got $100,000, my options are 2 things. I can go put the $100,000 directly into the real estate, or I can put the $100,000 in my sacred account instead and borrow against it to do the real estate. So Ted, he's smart. He puts it in his sacred account. He's like, no, I'm going to be my own banker. I'm going to use the infinite banking concept. I'm going to use my sacred account. So he puts in 100. He can borrow 90,000 out against his 100. Okay, so he's borrowing 90,000 out. He invests that in a real estate investment that's paying him 12% interest per year for 5 years. Okay, so that's $900 a month in income. He takes that $900 a month to pay himself back. Like we talked about, you pay yourself back. You would not put this $900 a month into your checking account with Wells Fargo. You would instead pay your policy loan back. You put it back to your own bank. You loaned it to yourself as the banker. You're now the borrower. As the borrower, you need to pay your bank back. Okay, so he's paying the $900 a month back to himself. He pays himself back with it. His 100,000 that he put in, it's growing at 3 to 5% per year tax-free. Right now, let's just talk about the borrowing and paying yourself back thing real quick. Let's say that you borrow 90,000 from a bank and it's a $900 a month payment. When you pay the other bank, let's say Wells Fargo, for example, you pay Wells Fargo or Chase Bank that $900 a month. Can you go to them and say, I accidentally paid you guys too much money. Can you give me the $900 a month back? No, they're not going to give you the money back. If you make a $900 a month car payment, you can't pull the money back out. They're not going to give it to you back again the next day. Right? That's not an option. Now, if you're using your bank, you're the borrower and you're the banker. So you pay the $900 a month back into your bank. And if you were to say, crap, I just had dental surgery come up for a kid of mine. My child needs, braces or whatever. I had a health insurance deductible, or I want to go on a trip. I need that $900 back. You can tell yourself, done. What are the terms? How are you going to pay me back? What's the interest rate? What's the monthly payment? And you would loan yourself that $900 back because you're the banker, right? So it's totally different than a normal bank. Most people think we're paying $900 a month and they think, oh, that money's lost now. Well, no, it's still there. It's in your bank account. You can borrow it back out again. Okay, so on this example, he's earning 12% interest, $900 a month. He's paying his policy loan back. His 100,000 still growing at 3 to 5% per year tax-free. After 5 years, his 100,000 is worth 122,100. He's earned $54,000 over 5 years in interest on his investment. His cost of interest for borrowing was $94.57. So he has a net profit between his sacred account and his real estate investment of $66,643. So he made a profit in addition to his 100 grand after paying for the interest of $66,643. If he would have paid cash and done the real estate deal without using the sacred account, Ted would only have made $60,000. Okay, so would you rather invest and be your own banker and earn 66, almost 67,000, or put the money with someone else's bank, go directly into the deal with cash and only have 60? Right? It's not a super hard thing to understand. So we want to keep this concept very simple. The worst thing you can do is overthink the details. Again, guys, details, we didn't talk about it. We didn't talk about a death benefit today. We didn't talk about the fact that loans never have to be repaid, even though you always should repay them. We didn't talk about the tax-free internal growth rates. We didn't talk about any of the nitty-gritty. We just talked about the concept, because people get lost in the nitty-gritty. I want you to understand the concept and actually be your own banker, not understand how someone else can be their own banker, how you can be your own banker by actually being your own banker, right? Everything in life gets done by be, do, have. First, you've got to be. How do you be the banker? Well, you set up a bank. By nature of being a banker, it means you have a bank. So you set up your own bank. Now, what do you do as a banker? Well, as a banker, you have deposits. So you need to do deposits into your account. You borrow against the deposits. You need to do the action of borrowing against the deposit. You need to loan that money out or invest it. So you need to do the action of loaning the money out or investing it. You need to be paid back by the borrower or by the investment. So you need to do the action of paying yourself back. And then you have the dividends. And as you do that, it's be, do, then have. As you do that, you will have more knowledge. You'll understand the system by using it. As you do that, you'll have financial results. You'll see that you're actually building, and you'll see your policy grows even while it's put to work. Right? The worst thing you could do with this is set it up and never take a loan. Then, yeah, you might as well leave it in someone else's bank because you're not being your own banker. This is not about a better savings account. Okay. So if you're watching this and you don't have a sacred account, you're not currently practicing the infinite banking concept. Okay. Let's level here. There's one or two things that's going to happen to every single one of us. We're either going to live or we're going to die. There's not another option. There's not, you're halfway. I mean, I would say most people are living halfway, but they're still alive, right? But they're halfway between living and dead. That's beside the point. That's more of a philosophical discussion of getting the most out of life, but you're either going to live or you're going to die. So if you live, we've looked at the math today. Are you better off with the infinite banking concept and the sacred account, or better off without it? Are you better off being your own bank or better off using someone else's? Now, if you die, we talked a little bit about this today, but you're going to get a tax-free death benefit that goes to your loved ones. So if you die, are you better off with this concept or without it? And the reality is you're better off Both. If you live, this is a better concept. If you die, this is a better concept. So dead or alive, this is the right concept for you, right? Now, the final thing I want to cover before we wrap up, why don't more people know about this? This is the question you're gonna have. Well, why don't more people know about this? My friends don't know about this. I've never heard about this before. You know, Dave Ramsey said not to. First of all, millions of Americans do. Okay. This is the concept the top 1% of wealth use. There's 330 million American people. 1% of that is 3.3 million. So there's millions of people who do know about this concept, right? Now, banks don't make any money when you use this tool. If you use your bank instead of theirs, they don't get paid. They have insurance licenses. They could sell this to you. They don't, because they would rather you use their concept. So they advertise for you to put money in a checking account and a savings account and a CD, and they'll get loans. Okay, Wall Street does not make money when you use this tool. If I could put my money in here and borrow against it and go invest in real estate, why in the world do I need Wall Street? If I'm becoming my own banker, why in the world would I lock my money up for the next 30 years where I can't touch it and it robs my bank? Money that I can't put in my bank robs my bank. The IRS does not make money when you use this tool. Money you put in your sacred account never gets taxed again. So do you really think between these three groups that there's any reason why you would be told about this concept? There's no financial incentive for you to know about this, right? Now, it's also not about how many people know about this, it's about which ones, right? Everyone knows you should go to the gym. How many people actually do? Everyone knows that you should read books. How many people actually do? Everyone knows you should eat healthy. How many people actually do? So I've been successful in life by looking at what everyone does and basically doing the opposite. Okay, so here's a quote from Warren Buffett. If poor people would just do what rich people do, they wouldn't be poor anymore. Okay, that's how I got successful, guys. I'm not a genius. I just studied what are the rich doing. I'm gonna copy it. I grew up in Big Lake, Alaska, 62 kids in my graduating class. I was a C student. My parents were divorced. I was homeless. I didn't go to college. I didn't inherit a bunch of money. And somehow I made it to where I'm at today. And it's not because I've got some special knowledge. It's because I looked at, oh, that guy does that and he's successful. Let me copy him. So I'm going to show you who does use this concept. Number one are the largest banks in the world. Not only are they borrowing against your deposits, not only are they practicing the banking concept, they put, when they get profit, the first money that they get in, their reserves, the most prized reserves they have, they put into the system. As of 2018, the largest 10 banks in the United States have over $82 billion in life insurance cash value. Guys, this is just the top 10. Not only is this just the top 10, this was 5 years ago. They've been buying more over the years. Imagine what it is now. So the largest banks on the planet are the number one owner and purchaser of the sacred account. Right? That's who's using this concept. Again, I'm not telling you to do anything that's not already happening to your money. I'm telling you to change one thing. Be the one that's doing it. Be at cause rather than effect. Okay. Now, who else uses this? Not only do 3,000 banks in the United States have over $200 billion in life insurance cash value, not only are they the number one buyer and owner of this kind of life insurance, President Joe Biden owns 6 of these. Okay, JCPenney, Walt Disney, Ray Kroc, Foster Farms, Stanford University, John Rockefeller, Senator John McCain, Pampered Chef, Waka Flocka Flame, if you know the rapper, President Theodore Roosevelt, Sam Walton. These are all the people who own this account that have done this throughout history. And this is just to name a couple of them, the ones that you guys would all know about, right? So if they're using this, and if we were to copy the wealthy, we wouldn't be poor anymore, and we put those two concepts together, what would that mean? We should use this concept too, right? And that's the conclusion I came to. Now, this is a quote from Will Rogers. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. If you're watching this before we wrap up today, the only reason you wouldn't do this is you believe in something different. You think you know something. I think the retirement plan is a good idea. I think that the bank is a safe place to save. I think that, you know, the current system is an okay system, but knowledge is evidenced in results. And I want you to take a minute and just apply some self-awareness and look at your financial results. Where are your results and compared to what? Don't compare them to everyone else. Don't compare them to your friends and family and peers. Compare them to where they could be. Compare them to the people we've looked at here. This is where they're at. This is the standard. This is the people who use this. These are the results they're getting. Meaning they have different knowledge and they take different action and they behave differently with their finances. And if we were to behave the same way, I firmly believe, and I'm an example of, if the poor people would do what rich people do, they wouldn't be poor anymore. It's not hard. It's not rocket science. Let's copy them, right? So your options are this, guys, at the end of this presentation. Keep putting your money in the bank, someone else's bank. You're going to get paid minimal interest. They're going to put your money at risk. It's a matter of time before you're one of the statistics of people who got robbed by a bank, right? We heard about bank robbers through our history. Well, the reality is the banks have been the ones doing the robbing all along. And it will happen, and it's just a matter of time. We could put it in retirement accounts with Wall Street, where you're going to experience market volatility. You can't access your money till you're 60, while fees eat away at your account regardless of performance. Or you can put it in cash, and you can lose your value year after year after year. Those are your three options, other than the option of starting your sacred account today, becoming your own bank, taking control of your finances, using a concept that's been around for 200 years. This isn't new. This isn't something that we're telling you to experiment with. So what I want to do today is, if you've not signed up for a sacred account, I want to invite you to do that, right? There's a point of learning, and there's a point where learning turns into action. And when something makes enough sense, it converts into action, right? And so if you're ready to take action today, the first thing I want to do is I want to suggest grab a copy of the book. Okay, so I'm going to pull this back up on the screen. This is my giveaway for you guys today. Grab a copy of the book. This is going to be jerryfetta.com/B2F promo. Okay, jerryfetta.com/B2F promo. So grab a copy of the book there. Okay, that's going to give you information. Now, one of my rules, and I'll tell you this because you guys are on the webinar, one of my secrets is, if you're not a reader, I don't want you as a client. I want people who are willing to invest in their future. That's why we do free books. It's a test. The first thing we look at is this person willing to learn? Because this is not a system of give your money to a financial advisor. We're responsible of you, not for you. We're responsible with you, right? We're going to help you. We're going to be in the driver's seat, in the passenger seat with you, teaching you how to drive. Eventually, you're going to take over the wheel and it's your turn. And we're there to coach you and mentor you. We're not a financial advisor. You're not going to give us your money and say, fingers crossed you do the right thing. I'm not going to pay any attention. And hopefully when I'm 65, it's ready. No, 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 no. That's not how this one works. You need to become your own banker. Okay, Nelson Nash's book, Becoming Your Own Banker, your own is in the title. The words your and the word own. Not become someone else's banker, not become a customer of someone else's bank. Become your own banker, which means you're in control. And you can't be in control if you don't have knowledge. So grab the book, jerryfetta.com/B2F promo. Okay. The second thing is, I want to get you a free consultation with Brianna today. Okay. If you go to the chat here, you can reach out to Brianna and just say, hey, I want to do a free wealth potential analysis. Okay, again, we talked about this at the very beginning. You can do a free wealth potential analysis, and we'll go through 100 questions, 100 wealth potential factors, and measure your answers against that to determine, where do you need help? What do we need to work on? What's the strategy? Okay, this graph changes lives. This is based on a very successful concept that we're duplicating in Wealth Dynamics. So you can get this done. It's a free 100-question assessment with Brianna. Reach out to her and just say, hey, I want to do a free assessment. Whether you're not yet a client, you're a brand new client, you're already a client, we want to do a free assessment with you. So reach out to her and she can get that set up with you. Okay, finally, I want to answer some questions. All right, we have a couple of questions. What is the difference between an early cash value dividend paying whole life insurance and a traditional whole life insurance? Okay, so traditional, we're getting a little lost in the weeds here. The traditional insurance is not designed to become your own bank. You cannot apply that concept with traditional insurance. It's a very specific design. It's got to be set up with the right company, the right illustration, the right everything. Like, it's very, very, very specific. Less than 1% of life insurance policies with cash value are designed this way. So that's the main difference there, is you can't become your own bank with traditional life insurance. Steve asked, are we using an annuity to keep and loan the money? No, we're not using an annuities. We're only using high cash value dividend paying whole life insurance. That's what the sacred account is. So I'm not a fan of annuities. We're not using an annuity with this. Let's see what other questions we have. Jason says the executives wired themselves bonuses. It's no wonder Jesus flogged those money lenders. Dude, that's the truth. Even back in the day, Jesus knew. He was like, yeah, these guys are criminals. Like the guy, the super, be peaceful and loving. The one time he ever pulled out a whip, it was on some bankers. That's funny. I hadn't thought about that before, Jason. All right, let me see if there's any other questions here. Jason says permission to share the book. Yeah, so Jason, you can share the book. You can share the link. You can loan your copy out to people. My goal with the book is not to make money. If it was, I wouldn't be giving it away for free. It's to reach as many people as we can. So feel free to share the book for sure. Okay, awesome, guys. I don't see any other questions on Zoom. Let me check Facebook really quick. All right, Facebook, if there's any questions or comments, let's see it. Let's see them. Nope. Okay, nothing there today. So guys, I'm going to sign off for today. So again, if you're watching this on the replay, you're watching live, wherever you are, whenever this is, if you didn't get the book, grab the book. If you didn't reach out and get the free consultation, the free wealth potential analysis, if you're watching the replay, just comment below. Comment below, say wealth potential analysis. We will know what that means. We'll get that scheduled and reach out to you. Otherwise, guys, thanks for watching. Have a great day, a great Saturday. And we will see you all next time. And I'm going to leave this open and put Bree in charge. So I won't close it. If you guys want to stick around and network with Bree, schedule appointments, etc., she'll be there to do that with you.
All right. Hey guys. So that wealth potential analysis, I got to kind of guinea pig it, and I highly, highly recommend doing it. Even if you're already a client, even if you're already feeling like you're winning with your finances, it's still, with those 100 questions, you still get to assess what points you're missing. And that kind of help you orient what you should be focusing on for your next step in the blueprint. Yes, I'll post the book link. Book link is at jerryfetta.com/B2F promo. Hi, Ian. Ian's one of the star clients. He's really engaged, definitely winning with this education and with the tools that he's getting. So if you guys want to see an example of what the success looks like when you come in, Ian, how long have you been in Wealth Dynamics? I think you're still under a year, aren't you? September of 2022. Holy cow. And he is just blowing through. He's going to be getting debt free this year. I know it. That's amazing. So we do encourage clients connecting together too. If you guys have questions for Ian, feel free to connect with him and reach out, ask about his experience. All right, so I'm going to be doing a wealth assessment for Jason. Ian, did you get to do a wealth assessment yet? Okay, awesome. Keep focused on income. Okay, let me go ahead and put you on. And this is completely just going to be a free tool that's going to be there. So this will help us just connect with people that maybe they're already a current client, or maybe they're just not ready and they want some guidance on their finances. But this is great. I actually found some points that I need to work on for myself when I did it. So journaling every day, that's a great habit to have. Awesome. Okay, so Jason and Ian, I'm going to be getting you guys both for the wealth potential assessments. That's true. Very true. Always something to improve. Awesome. Okay, do we have any more questions? All right. Andrew, I will go ahead and connect with you to get you that wealth assessment. Writing down your guys' names so I can touch base with you. That's absolutely right, Ian. All right, awesome. I've got Jason, Ian, and Andrew for your wealth assessments. I'm going to go ahead and get that together for you. And like Jerry said, this will give you a graph and just tell you all the different points of what you need to work on. Like I realized I need to get more on my protections for my money. So I need to make sure all of my legal and insurance stuff is set up for it. It is fancy. Lots of S's in that one. Awesome. All right. So guys, I'm going to go ahead and look at ending the chat here soon, ending the webinar, just because there's no more questions. And I think I've got everyone. So I'm going to post my link one more time. If you're still on and you just want to chat, if you're a current client, if you're brand new, go ahead and use this booking link. I'm down to talk, even if it's for 5 minutes, half an hour, doesn't matter. I will get your questions answered and get you guidance on your next steps. All right, guys, you have a happy Saturday, and I will see you all next week. And for Jason, Ian, and Andrew, I will be touching base with you soon. Allie, I think I'm going to go ahead and get you one of these wealth assessments as well, because I know you just recently started. And this will help your mom and you. Okay, awesome, Ian. I'm looking forward to chatting with you. Great, okay. Let me see who else was attendees. Absolutely. Very welcome. Okay, guys, thank you so much for taking the time and joining us today. I hope you guys got some good knowledge and motivation to go out and make this weekend very productive. So I look forward to connecting with you all soon. Take care, guys. Happy Saturday.